What's going on, everybody? My name is Zach Hartley, and in this video we are going to be taking a look at Datadog. This is a stock that I've pointed out in my watch list at least 2 or 3 times now, and in the last week the stock is up by like 20%, so it's doing extremely well, and I think we could be at the beginning of a bullish trend. So in this video I want to give you a brief summary about the company, about what I think of the company, and where my technical analysis is at. Unfortunately, we missed the best buy-in opportunity so far, at least based on what we have right now in previous data, but hopefully it's not going to be too late. I'm going to give you my strategy at the end of the video, so stay tuned to the end and let's jump right in. Okay, so first of all, Datadog trades on the NASDAQ under DDOG. The company is headquartered in New York, and the current price as I filmed this video was $86.01. Here is a photo of, or a basically screenshot of their logo, and the website is datadoghq.com. Now the business model at Datadog is very simple. They are a software company. They sell that software as a service. It is a SaaS business model. That is what this means. If you ever see this in any type of written text, SaaS or software as a service, basically means that they sell the software usually on a monthly and recurring basis. Now, what's interesting about Datadog is that they're focused on cloud monitoring and security. They have a variety of products within that category, and here in this photo you can see the timeline of the company and all of the new products that they have been developing. 2022 was a big year, and 2023 is also shaping up to be a big year. Now, when you find a company that you're interested in, which is kind of where I started with Datadog, I was like, oh wow, those financials look really good. It sounds like they've got a good business here. The one thing that you want to do is make sure that this company is actually in a growing market. And so when I did some just research on cloud monitoring and cloud security, it looks like this industry is growing at 13.7% cumulative average growth rate in the global cloud security market. And so this report came from 2022, so it's about a year and a half old at this point. But that is an extremely high number for an industry growth rate. Anything above that 5 to 7 mark, in my opinion, it would be considered very high growth for an entire industry. And so the fact that this industry is growing by 13.7% and the company is growing pretty quickly as well, those are 2 really good signs that I really like. Now, when it comes to recent news from the company, they just put this out May 10th, like literally as I was filming, well, a couple hours before I'm filming this. Datadog integrates with OpenAI ChatGPT to help organizations monitor AI usage, costs, and performance. And so this is exciting because not only do they have this cloud security and cloud basically monitoring software, but now they're incorporating AI to make everything more efficient, to make it more user-friendly, and to give more utility to the software. A couple of days ago, they also announced their first quarter financials, and they gave kind of a brief synopsis here and a brief summary. All of these numbers look really good. Their revenue is growing by 33% year over year. We're going to dive into the financial statements here real quick, but they put this out, they just kind of summarized all of the highlights here. And honestly, almost all of the news was really, really good. Operating cash flow was $133.8 million. Free cash flow was $116.3 million. Like, the company is doing extremely well. Now, in previous news, April 19th, this was a little while ago, the company's also expanding. I thought this was just kind of interesting that they opened a data center in Japan. So they're definitely going after that Asian market as well, which is huge. So this is a global company, just to put everything in perspective. They're not just focused on the US, they are focused basically worldwide. Now, I like to start with the balance sheet when we analyze financials. The reason I like to start with the balance sheet is because it helps you understand how the company got to where they're at today. If a company does $1 billion in revenue with no debt, that's really impressive. But if a company does $1 billion in revenue with $2 billion in debt, you want to know that before you look at the revenue so that you can kind of put it into perspective. So that's why I usually like to start with the balance sheet. When we look at the balance sheet here for Datadog, it's really, really interesting, and I'll explain why. First of all, $222 million of cash. So not a ton of cash, especially compared to their marketable securities, but definitely enough to run the company and probably do extremely well. So not a huge concern there, especially since they're marketable securities. They could convert those to cash, no problem. So cash position for the company is good. When you look at total assets here, it's $3.1 billion. Okay, that looks good. When you look at the liabilities here, their total current liabilities is my main concern here and what I'm looking at. And you can see accounts payable 41, accrued expenses 148, operating lease and liabilities current 20 million there. And then you see this one here where it says deferred revenue current $562 million. And what deferred revenue means is prepaid payments from the customers. And so if somebody buys a year-long subscription, but they're only on month 3, then they have 9 months left that is considered deferred revenue. And this is where it is stored on the balance sheet. And so when you look at this, they have $772 million worth of current liabilities, but $562 million of that is probably sitting in their bank account earning interest right now, and it's basically just prepaid deposits from their customers for services that are yet to be rendered. So this balance sheet actually looks really, really healthy. And instead of $772 million in current liabilities, it's really closer to like 200, because this isn't really a liability. This is just money that you're holding for somebody else, and hopefully they're earning an interest rate on it. So the balance sheet here, in my mind, looks really, really healthy. When it comes to the income statement, it's kind of mixed results. They're not profitable yet, so let's just get that out of the way right off the bat. Net income or loss rate here, they lost $24 million. That is okay though, in my mind, because their revenue is growing so quickly. Their revenue is up by 33%, which is super, super impressive. They also have a very low cost of revenue. It's like 20% right here, a little above 20%, I guess. And the gross profit is amazing. And so I'm not super concerned about this company's ability to generate profit as long as the revenue continues to increase. As long as that revenue number continues to go up quarter over quarter, which, because they sell on a monthly subscription, basically, it shouldn't be too much of a difficulty, or it shouldn't be too much of a problem. And so I think this company is going to be very profitable in 1, 2, 3 years from now. And I think they could be break even, or could be profitable right now if they wanted to, but instead they're spending that money on research and development, and they're spending it on marketing and faster growth to basically accumulate and capture market share and grow as quickly as they can. And you can see that here in the income statement. So this is their income statement, basically kind of mapped out in bars on a quarterly basis all the way back to 2018. And you can see that the revenue just continues to climb and climb and climb. And so that's why I'm not worried that they're losing money right now. It's because they have tons of cash they have cash in the bank, they have tons of marketable securities, they have low liabilities, and this revenue continues to increase. So I like the direction of this company. Now, when it comes to the stock chart here, the stock has very clearly fallen from $200 all the way down to $61.34. And when you zoom in here, it's very clear to see that we are trading within a channel. We've got support at 61. We have bounced off it at the beginning of March here. We've bounced off it at the beginning of April, and now we've just bounced off it here at the beginning of May. We have soared all the way up to like $86 as I take this screenshot. I think it closed slightly higher than this. But basically, we've got some resistance probably around this $88 to $90 range. And so this is going to be interesting, because we've seen such a massive run up from 65 to, let's call it, $90. I mean, that's like a 40% increase. And to see the stock continue for, let's say, another 40% increase, that is quite a stretch. Now, it's possible, but that's quite a stretch. What I would expect to see is a little bit of resistance around this $88 or $90 level, possibly a breakout and a retest of $90. And if we saw that, I would be buying in on the retest of $90 going higher. Now, if we get rejected at $90 here and we don't get that breakout, then I want to see the stock come back down to, let's call it, $70 to $62 in here. I want to see it come back down in there. And as long as we hold up with support, I like it. I'm buying in. I think there's great momentum here. I think the company's going in the right direction. And if you can scoop it up along support here, you can set a nice stop loss below support so you get in with a great risk to return ratio. Now, when it comes to the valuation of this company, it's a little bit tricky. The market cap of the company is $24 billion. And they are not profitable, so I like to then go to the price to sales ratio, which is 12.4x, meaning that this company's market cap is worth 12.4 times the sales that they are bringing in, the revenue that they are bringing in, not the earnings, but the revenue. That is expensive. That is not a cheap company. That is not a value company by any means. And so you have to factor that in. Now, when you look at the price to book value here, it is also expensive. It's 15 times the book value, which is basically what's on the balance sheet compared to the market price. Like, it's expensive. It's still an expensive company. However, the company is putting up 33% revenue growth quarter over quarter with great margins. They have a healthy balance sheet with a current ratio of 3.19, and realistically it's actually higher because that deferred revenue makes up most of their liabilities. And so Their current ratio and their balance sheet is super, super healthy, and they're already very close to profitable. I'm sure they could tone back a little bit of spending on R&D or marketing and be profitable almost every quarter if they wanted to, but it might slow down their growth. And so they're towing that line between growth and profitability up to a certain point, but I think that their margins are so good, I think it's going to work out well for them. And so it's this balancing act between, is it a good value right now with the growth that they have compared to the price that you're paying? And it's a tricky one, but I think around these levels, we have great technical support. So if you can get in with a good risk to reward ratio, I am fully in support of this company, and that's exactly what I plan to do. So in summary, I think this is a great company with a bright future and strong financials. I don't see a whole lot of red flags in this company, which is really, really nice. I think it is selling at a good price, but not a great price. It is a fast growing technology stock that is not profitable yet. So there's nobody out there that can say, this is exactly what this company is worth. This is how you should value it. Like, that doesn't exist. That doesn't happen. And so for me, I think the goal should be to find great companies like this. So this company has made my list of something that I think has major potential, and now I'm looking for technical opportunities. I think it's in the range of a decent price. I don't know exactly what the best price is for this company, but I think it's in that range, and so now I'm looking for technical opportunities. The unfortunate thing is that I did miss the trade. I had pointed this stock out on 1 or 2, maybe even 3 watch lists, and realistically the best trade here was to buy in on this green day right here, where we saw a spike in volume, we saw some good bounce, we saw some good momentum here, and then set your stop loss at like $60. You could have got in at 65, you could have got out at $60, and you could have been at $86 already. And so I missed that trade. I'm kicking myself a little bit for it right now. I apologize if you're in my Discord chat. I've been talking about this stock and we missed the best opportunity. It's bugging me right now. So if you're in my Discord chat, I apologize. I do like the stock long term though, and I'm waiting for the next technical opportunity. If you're interested in learning more about any of this and you're not in the Discord chat and you haven't taken my courses, they're totally free. They're hosted on Skillshare. They're 10 hours long, or at least for the stock market fundamentals course, it's 10 hours long. There's 14,000 students that have already gone through the course. There's over 400 reviews. You get the first month of Skillshare free when you sign up with the link in the description to this video. That's it for me though. I hope you guys got some value out of this video. It wasn't sponsored at all. This is just an exciting company that I think needed a dedicated video for itself. So thank you guys for watching. I sincerely appreciate it, and we'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.